Thank you. So we are now recording. So we're going to stay live on the mics up here. We get to the end, or if you guys have a question you just can't wait, we'll get a mic to you or shout it out. I'll restate it, but we're going to record this. We'll probably put it up on our website. I think some of the panelists want to use it, maybe for their websites or somewhere. So that is why we are recording this. So at this time, I'm going to turn it over to Courtney a little bit here to do some introductions of our panelists, and then we'll get started here. So Courtney, go ahead.
Thank you.
Please.
So I'm Courtney Zog, and I help with the IoT Lab and Lunch Fishers to put on events such as this. So recognizing that we have a lot of really great panelists today, I'm going to read their bios because we also want to make sure that there's enough time to talk through the questions that we have prepared, and we have some Q&A time at the end. So first, Jennifer. Jennifer Hall is the executive director of Bankable. She's a nonprofit executive with over 2 decades of experience in lending and nonprofit management. She currently serves, as I said, as executive director, and Bankable is a mission-based lender that provides financing and consulting services to entrepreneurs who are typically unable to receive loans from traditional financial institutions. In her role, she leads the daily operations, including originations, closings, and asset management of its $10 million portfolio. Jennifer also supports efforts to raise and deploy special funding sources, as well as strategies to best support underserved entrepreneurs. Thank you so much for being here. Next is Stephen Meyer. He is the CEO of Intent Indiana and the Build Fund. Intent Indiana is a nonprofit that advances comprehensive community development through innovative financing and development solutions. Stephen oversees the strategic growth of the organization, including its 2 community development financial institutions, which you'll hear much more about today, CDFIs, affordable housing development, and land banking initiative. Prior to joining Intent, Stephen worked for the City of Indianapolis and the Indiana Department of Environmental Management, focusing on brownfield redevelopment and environmental cost recovery litigation. He is a graduate of IU McKinney School of Law. How many other attorneys do we have on the panel? Oh, good, just one.
Oh, good, just one. Do we have any in the audience?
The audience, I should say. Okay.
Oh, we have 2.
Next, we have Gavin Fisher of Midwest Business Financing. He's the president. So Midwest Business Funding is a boutique commercial finance company located here in Fishers, Indiana. It was founded in 2008 and prides itself on helping small business owners keep their lights on, their doors open, and food on the table for families that rely on them. He started his career in the sports industry with the Indiana Pacers, and moving on to Butler University in the athletics department. For over 20 seasons, he has continued to do work with Butler Athletics as the public address announcer for volleyball and women's basketball games. I had no idea. Gavin changed direction in 2004 and started a new career path in the banking industry. Over his career, he has done personal loans, investment advisory, led small business lending teams, led a retail branch footprint, commercial lending, and private banking. Under his leadership, he has led salespeople and teams to the top spot of their respective companies. He's lived in Fishers since 1999 and has held various board positions in the community and his industry. Welcome, Gavin. Next, we have Steve Iskander. He's a founder and serves as the managing director, CEO, and board member at Intrepid. They provide tech-enabled revenue-based financing to early-stage software and tech companies nationwide. His mission is to provide early-stage businesses a streamlined and hassle-free I'm too electric. You're supposed to laugh. That was funny. Where was I? Okay. His mission is to provide early-stage businesses a streamlined and hassle-free experience to gain the growth capital they need to achieve a higher level of growth. He is also the owner of, Masick Management Group, where he advises companies in the Midwest through various stages of growth. He takes on a hands-on approach, working closely with teams and founders alike to provide exemplary. It's a long bio you got there, Steve. Exemplary advisory services to transportation firms, pivoting most recently to focusing on tech. He's been featured in several different media outlets like FreightWaves Radio, Indiana Business Journal, Supply Chain Brain, Food Logistics, so on and so forth. He graduated with his bachelor's from IU Bloomington with an emphasis in business. He also serves on the Ball State University MBA Advisory Board and Ball State Sales Technology Advisory Board. Thank you. Welcome. Next, we have Mr. Scott Noble. Scott is a strategy executive and entrepreneur. His experience ranges from technology startups, equity hedge fund and commodity trading, venture capital, and corporate product portfolio strategy, including buy-side of M&A. He has held positions at Autodesk, Hexagon, and early-stage technology companies. Scott has given back to the community by helping aspiring entrepreneurs and students. He serves as a judge for Notre Dame's McCloskey New Venture Competition and by guest lecturing at multiple universities about business ethics. You should Google his name. Mr. Noble studied computer technology at Purdue, IUPUI for 3 years before completing his BS in accounting from Indiana Wesleyan University and an MBA from the University of Notre Dame. Thanks for being here, Scott. Next, we have Landon. Landon is VP of Pre-Seed at Elevate Ventures. Landon has a very interesting background. He's a transdisciplinary entrepreneur, educator, and investor focused on high-impact technology innovation. He was named one of the 13 Kauffman Foundation Global Scholars in 2013. If you don't know that program, it's the elite of the elite. He was awarded the National Science Foundation Fellowship in 2011, is a founding curator of the World Economic Forum Global Shaper Hub in Kansas City, and in 2018, the MP1 Fellow. He holds a PhD from Purdue University, completed his executive education at Harvard. He was also an advisor for Stanford University's International University Innovation Fellows Program, which is a design thinking and entrepreneurship program through the school. He is the current vice president of Pre-Seed at Elevate, which is the Midwest's most active seed stage fund. He's also an active advisor and board member for several venture-backed startup companies. Landon, thanks so much for being here. And next we have David. If you don't know David, you need to know David, because David is the executive director of Launch Fishers and the Indiana IoT Lab. He joined the team initially in 2012 as CFO. Before that, he served as CFO for 2 Indianapolis startups, both sold successfully for owner exit. He is currently president and owner of WishU Technologies and is a member of Ball State University's advisory board for the Department of Management. He's a proud graduate of University of Indianapolis, me too, where he earned his bachelor's in accounting and economics. I'll hand it over to you, David.
Wow. Thank you, Courtney. Great panel up here. Looking forward to getting this going. This should be an interesting session here. We're going to spend about an hour together up here. I think as a group in 2 separate calls, a week and a half ago, we spent more time preparing for this than what we have to talk. As you can imagine, there's a lot to talk about as we go through this this discussion of the Capital Continuum. So, you'll see me look down. We've kind of shared with the team of what we thought were maybe 8 to 10 questions that we thought we could kind of navigate, go through, and kind of level set, and at least get everybody thinking on a good discussion, a good topic, time frame. We're not going to get all the questions answered here, topics and all that. You guys all know this is a very deep conversation, so we'll spend a good hour in conversation, and we'll leave some time at the end for your questions of the panelists, the experts up here, and we'll be happy to go through that. Like I said, as we're going through this, and there's something that you guys want to have a question immediately, raise your hand, and we'll take it at that time as well. So. I think we probably should have put a slide up here right now of like a disclaimer that's this is just for like a conversation point only, right? That this is not like expert advice or anything like that. Maybe we should have that up there. Or
are you looking at the lawyer?
I'm looking at the lawyer, but are out here, or it's like this is for discussion purposes only. But let's get started. We'll just jump in, and I think where we all wanted to start, and as a group, it's important here for us and kind of for me and where we play in this building at Launch Fishers, the Indiana IoT Lab, and kind of defining and putting a baseline out there. We've talked about this. I'll ask each of you maybe in your own words and as you're talking with your clients, but I want you guys to kind of quickly talk about and define a small and medium enterprise versus an innovation-driven enterprise and why it matters. So we'll just start here to my left and work our way around and kind of let's just let's just start that baseline. So kind of define it in your own words. We know there are a lot of definitions out there, but then that definition and why it matters to you and your daily workings with your clients.
So I am not even going to try to define a innovation-based enterprise, because that's the other end of the spectrum here that we're talking about. Build Fund, which is our CDFI, which is a community development financial institution, is the way to think about it is like a mission-driven bank. And so we're very similar to thinking about how we invest in businesses, primarily small businesses, as a bank would, but just with much more flexible terms, better underwriting. We spend more time with our borrowers to understand the specific challenges that they face than a bank would. But we're typically on the kind of cash flow lending side of that spectrum, kind of the step down from a bank. And so that's kind of how we play in the capital spectrum.
Yeah, similarly, we are also a mission-driven lending institution, and we work primarily with the Small Business Administration, the SBA. And so the SBA defines a small business as less than 500 employees. As we see it in the markets that we work in, is more like less than 50. But even more so than that, we see a lot of startups and very new businesses, those micro enterprises. So that'd be 5 to 10 employees, maybe 1 to 2. And so small is really small when it comes to our mission lending platform.
You can hear me. The Kauffman Foundation published a white paper a few years back called The Tale of Two Entrepreneurs to try to solve this, because it is hard to tease these things out. They define an innovation-driven enterprise as one that's seeking out a national or global market as opposed to local or regional. And also at the core of the business is some fundamental novelty. There's something new that hasn't been done in that way before that's core to the competitive advantage of the company. There are other things as well, but total addressable market, we tend to think of $500 million or more, right? Again, national or global in nature. I'm in Elevate Ventures, and we are also a little different. We're a nonprofit venture firm, and so we're a venture development organization and VC, and we are looking to invest in innovation-driven enterprises, so those that are looking at bigger markets that have innovation at the core of what they're doing and fundamental to their competitive advantage.
Yeah, so again, Steve with Intrepid Finance, and for us, we work with both sides, the small business side and the innovation organizations nationwide. So from a small business side, we really look at it from a local or regional capacity, how many employee count, what the total addressable market is, not from a revenue, but mainly territorial. And the innovation side of it is from the overall expansion and disruption. So from a Tesla or an Uber versus maybe a smaller business that's serving more of the local needs of, say, a plumbing company, a coffee shop along those lines. So we're really servicing both sides of the industry or business size.
So the way we're Vision Tech, and so we're actually a for-profit investing firm similar to Elevate, and we look for the innovation companies. The way we usually break it down is there's lifestyle businesses, which are definitely small businesses. So if you want to open up your flower shop or your bridal shop, or you want to open up some other type of service business like a plumbing store, those are awesome. I've had lifestyle businesses myself. But we're focused on investing in innovation-driven companies with those larger market opportunities that are exitable to larger companies. And that's our primary goal, is there's some liquidity event after you get started that you grow into and you're attractive to then to either a bigger buyer Or if you're one of the unicorns, and they're called unicorns because they're so rare, like the company itself can go to an IPO to get that liquidity market. So we're very focused on the innovation, and we are very profit motivated. So we are focused on the team and all the things that make your business unique and why it will succeed in the marketplace.
For us at Midwest, we also play in both spaces. Our definition of how to categorize those companies would be a small, medium-sized enterprise is going to start out a little bit in the red, but probably get to the black on your accounting books fairly quickly, or that's the projected plan. The innovation side typically has the grand idea that can grow globally, as we mentioned, but it's probably going to be in the red for a while and take a nice swoop before it goes. But once it goes, it's like a rocket ship, and it's just going to take off, right? I use rocket ships, so think Tesla, and SpaceX, and all that, just taking off once the idea is there. So from a funding standpoint, we got to look at them totally different. One's going to be a little bit faster to the black, the other one's going to take a little bit longer time.
All right, good. One more question here as we kind of establish a, kind of this baseline here, and then we'll kind of flip it to the entrepreneur, the business owner. As we're thinking about, from you guys and your perspective in your organizations, and you think about these, the innovation-driven enterprise, the small business enterprises, talk to me a little bit about, those businesses that you guys are going to invest in from your organization. So what funding options are available to the business owner, the entrepreneur? We'll come back here, we're going to be like a snake draft. We're going to come back here, Gavin, you're going to lead off of, talk to me then as you look to, is it that innovation-driven enterprise or the small business enterprise that you're looking at, that's your target, and then what funding options are available to that business owner or entrepreneur?
Sure. So as mentioned, we do both. I'll say we're better in the small, medium-sized business enterprise. The reason for that is kind of like more of a traditional bank. We like a little bit of a track record to see where it's going. Also, we are private money. As Courtney mentioned, we're just up the street on Allisonville Road, so we like to invest back in the community. And we use our own cash to do that. So we want to see a little bit of a track record to know how that cash is going to be used. On the innovation side, we will reach out to folks on the panel. We entertain it. We'll say, hey, somebody's probably better at it, and we try to bring in a partner that's going to do that for you as well.
Sure. So the opportunities that we look at for startups, they're all going to be very small. We expect there's some early funding, whether you're self-funded, we usually call it the family, friends, and fulls round. So we classify things as round, what stage you're in. So that early round, there needs to be some capital that has been put in, by your close-knit circle. Then there's usually what's called promissory notes or convertible notes that you've solicited a next wider concentric circle of contacts. We come in slightly after that. So what we call a pre-seed round, which is probably still convertible notes that convert to equity later, and then seed rounds, and that's where we start. So for example, you would come to us when you're probably looking to raise $500,000 to $3 million in that pre-seed to seed round, depending on the type of business you are, and we'll start entertaining, the pitch and looking at what the opportunity is, and then advancing you through our progression to get the members to invest.
Yeah, and for us, again, we're playing on both sides of it, the small and medium business, and then same thing on the innovative side. We're looking for really growth, and the growth being regardless of the stage that you're in as a company. And you can be pre-revenue, but what is that growth in the demand? So if you have an order already, we consider that growth, even though you don't have revenue, and that growth needs funded. So we see it a little bit different because instead of what we consider a typical angel or a VC side of build it and they will come, in our model, they've come already. They might have placed an order, you might have a PO, and now you're looking for funding to be able to fulfill your obligation.
For the innovation-driven companies that we invest in, those companies are somewhere between scratches on a napkin and Series B financing, where it's a more mature company. For the companies at the very early at the beginning, as was mentioned, it might be Aunt Sally who's writing you a check. It could be a group of angels who have grouped together to go in and make an investment. It could be that you do convince some other institutional investor who plays in the pre-seed arena to come in and write a check, probably on a convertible note. Sometimes safe notes are also used. At Elevate, we prefer not to use safe notes. We can dive into that if we want to. You also have, if you're very innovative, the government wants to support your innovative work, and so they've created grants. SBIR and STTR grants are available to you as well. Those are non-dilutive. They don't take part of your company. And an organization called ARI here in the state administers matching funds for the state as well. So you get federal funding and state funding, non-dilutive. There's also a program in Indiana called the Innovation Voucher Program. So you can have up to 50% of a research project reimbursed to you from the state. And again, ARI manages that as well. Lots of options here in Indiana. It's a great place to start a very early business.
At Bankable, we work with entrepreneurs who aren't quite ready for a loan at the bank. If someone comes to us and they've not been to the bank first, we're going to ask them to go back and try to get a loan from a bank, because that's really the best long-term strategy, is to have a relationship with a bank where you can have access to funds. But we also know that there are many barriers for entrepreneurs in order to get a loan at a bank, and that could be a credit score, it could be that your business is too new and the bank's wanting 3 years of financial history. It could be that you've not had a positive revenue, any number of things. And so we work with those entrepreneurs when the bank says no. A lot of times we can say yes. We make term loans, so loans that are amortized over a certain period of time. Typically, we like to make those loans 10 years or less, because we really see Bankable as kind of the minor leagues. You come to us, we're going to make you a loan with some fair terms, and then we have grants from the federal government that we use to coach and to train and to help our entrepreneurs to maybe get a handle on their finances. Maybe they need a little bit of help with QuickBooks. QuickBooks is really complicated if you're not an expert in that area. Maybe need some marketing help. And so all of those support, those wraparound services we provide to help you to get back to the bank to become bankable. We lend anywhere from $500 all the way up to $350,000. And we price our products a little bit higher than the bank, again, because we want you to get back to the bank. That's your incentive.
And Build Fund's very similar to Bankable. Our loans, well, I'll point to Devin in the back. He actually runs our Build Fund for us. Our loans kind of start on maybe the 25,000 range and go up to well over $1 million. Sometimes we're doing participation loans with IEDC or with a bank partner that's doing a portion of the loan. And our value really is that we're very flexible with how we can put capital into a project. So that could be, helping to finance a contract that a contractor just received, or something as complicated as a new markets tax credit deal where you really have to subordinate to a lot of other lenders in order to get the deal done. So we take the time to try to figure out how capital could best be used to get these projects done.
All right, let's flip this around a little bit. We've talked about ourselves and, the panelists have, and where we want to get involved and lend. Let's start coaching, advising a little bit, kind of the rest of the way of coaching the entrepreneur, the founder. And let's start talking about when should we, when should a founder consider looking for capital and why? And, I don't want to give this away too much. We talked about this in a couple of our sessions when we broke this down of, it's not the, hey, I need some money next week. I'm in a pinch, or I've got this going or that, So let's kind of talk about, what's that process look like? And let's start going through, our advice of when should we start thinking about that process of looking for capital?
As early as possible. So I would say it's really important to understand what your goals are with your company. If it is an owner exit, then it's not starting with somebody like Bankable or Build Fund. If it is, if this is a company that you want to grow and own for a long time, and you maybe want to franchise and you want to get to the point where you're working with a bank partner to help you grow long term, I think those are the kinds of questions that you really need to think through before you even contemplate what capital you're looking for. And as far as with us, we can typically turn something around if you're really prepared in probably 60 days. But usually we'll take some time and think through like whether what you've come to us with is actually what would be best serving your needs. So we may actually know of a partner who could do a portion of the loan in better terms than what we could, or we have a bank partner who has down payment programs that you could access. And so I would say, as early as possible, but also not being concrete in what you think your capital needs are going to be.
Yeah, I would agree. Some of the things that we see in our applicants, our clients, is that they don't have their taxes wrapped up. You need to make sure you're on top of that and really start planning with your accountant maybe a year in advance about how you want to present your financial statements in a way that will set you up for success in trying to get a loan. I think that also, and we'll probably talk about this later on in the panel, but really understanding where you are in your business and your strengths and your weaknesses, and being able to very succinctly describe that to the lending institution is really critical. So the preparation is key as far as we're concerned.
As far as raising venture capital dollars, I would suggest reading as many blogs and pieces of content as you can on what it means to raise VC dollars and the opportunity and the cost associated with it. You're taking on additional bosses who might sit on your board. You are stepping on a treadmill of sorts that will only keep getting faster. And for some people, they want to run faster and faster, but it may not be appropriate for you and your business. We're able to make a pre-seed investment of up to 100K in as little as 3 days, and we did one in 2 days recently. That is not as common. Usually it takes a few weeks, but pretty short timeline with our new pre-seed fund. I would reach out to as many investors as you can who you think might be a fit, and ask them questions like, how did you get in this industry, and what do you look for in companies, and just get to know them as a human being, so that in the weeks, months, or years following, you can reconnect with them whenever you're making an ask for hard money. I would also put together a list of 20 or 25 of those folks, and then when you are ready to raise, go to the bottom of the list of the least likely one to say yes or the worst fit, and connect with them and share what you've been doing, get feedback, and then move up the list until you really hit your sweet spot of investors who are probably the best fit for you. That way you've worked out some of the kinks.
Before we move on, that investment of $100,000 in 2 days is probably an anomaly. I mean, not to discredit, but what was like, wow, they had everything in order. It was just smooth. A lot of history. They were hitting a lot of marks. Give us a little bit of insight, if you can, there. Expand on that for a minute of what you saw there just from that situation.
Yeah, so Elevate, we put together our due diligence requested items in a PowerPoint. And so any of you can reach out to me and say, hey, what do you look for in due diligence for when I'm ready? And I'll tell you exactly what you need to have. This company had prepared everything. They had seen our deck beforehand. They had seen what we requested. It was all ready. They signed things immediately. We post our convertible note terms online, so you know exactly what we will be sending to you. Identical, verbatim. So he went online and read the terms. He was comfortable with them, as was his counsel. And so we were able to send the offer and immediately received all of the signed term sheets. Then it was just a matter of Phil on our team being able to process that among all the other investments on his desk. And he was able to do that in just a few days. We've consistently, we do track our median and average time to closing, and it's tracking around 30 days. But many of them are less than 2 weeks.
Yeah, and for us, we're really looking for a couple of top things, right? What is your plan? Where's your MVP at from if it's a product or service? And what is your demand for your product or service? And that demand could be one customer or one agreement that you already have in place. On top of it, we run a marketplace of over 100 private lenders nationwide that instantly match in less than 3 seconds on who would fund a deal, trying to put an entrepreneur or a founder into the right capital stack. So instead of just going out for any capitals, when a founder's thinking about capital, what is the right type of capital that they're looking for? And it's where am I now, where am I going? And based on that, we can put them into the right capital stack to allow them to have access to growth capital, regardless if it's hardware financing or working capital, based on, quote, that demand. And again, the demand could be your first customer.
I'd have to wholeheartedly agree that it's never too early to talk to all the different sources of capital your business may want. So focusing on the angel and venture capital, where Elevate is a fund and they can, you have a committee that's smaller. We're set up as a member-based group. So we have a little more protracted process, but usually we're 30 to 60 days for getting approval, and then it's just a matter of a few more days to get, wires done and everything. But the more prepared you are, absolutely true. The more, if you've networked, talked to the different angel investors, talk to 20, 30, 40, 50, and understand that process, the easier it will go. So if you need a lot of coaching, and we have people come to us that need coaching, and we actually will hold at no charge, like pitch practice before you pitch to the members. Like if you've gotten through the screening committee that we have, then we have to pitch to the members, and the members do a straw poll. And if we have enough money in that straw poll, then we'll push you to due diligence. So that's our particular process. We can get that done. Things that we like, we have one now that we really like. Can't disclose the name yet, but we're going to get it done in about 30 days because their round is closing fast, and we want to get in. So we're motivated to move too. If you're not as prepared and it's a slow raise because it's harder to find different investors to also join this round. So by the way, we don't, angel and VCs aren't the 100% funders of a round. That's pretty rare. There's some out there that do take your whole round, but it's spread across multiple investors. So that's why you need to network a lot. And then I don't think I've turned anybody down for any mentoring. So if you reach out to me, I'll be more than happy to kind of walk you through the process, regardless of what stage you're at. But yeah, you can't start too early because the better prepared you are, the easier it's going to be later. And when I say easier, that doesn't mean it gets easy. It's still very hard because you're going to get 80% no's before you get to the group of investors that'll fund that particular stage.
From my standpoint, I say preparation. We've all hit on that. Preparation is key. Be prepared. Know what you're wanting. Know the ask and how you want to get there. And then do some due diligence, talk to mentors, talk to other folks in your own space or other entrepreneurs that you lean on for good advice. Steve mentioned capital stack, and that's key for all of us, but for those that are lending into a company, maybe a little bit more. So come with an open mind. A lot of times we'll see an entrepreneur come to us or give me a call and say, hey, this is what I need. And 3 questions in from myself or the sales team, you realize it's not actually going to work for your company. You really need to maybe go this way. Call an angel investor, call a VC partner instead of us, or instead of a line of credit, maybe it is a term note that is a better suit for you. So come with an open mind. Lastly, I'll say, try to figure out when you don't need money and then start preparing to get that money. It's a lot easier to get some stuff raised or lent to you when you actually don't really need it. I know that's kind of odd because we all panic and say we need it now. But if you can prepare in advance and say, I don't need it now, I'm going to go try to get that loan, then you're probably going to get it a little easier, quicker than if you wait to the last minute.
Yeah, and want to add a little bit of, Scott, and what you've heard is a little bit about coaching and mentoring. And I think that that's a real look in the mirror on, are you really going after money? Or are you going after coaching and mentoring? Do you need a co-pilot? Do you need someone to help you out? And that's a real look in the mirror for people. Is it, I think you often hear people say, well, I really need capital. Well, you probably really need a co-pilot as well. So to help you navigate it. And that's a look in the mirror that you have to be honest with yourself, especially early on when you're getting outside capital. The co-pilot could be your VC or your angel, or it could be bankable or a mentor or a consultant that you went and borrowed money to hire a consultant to be your co-pilot. But it's a really important piece of, what are you really going for? Are you going for the capital? Or are you going for a co-pilot that can help lead you to additional capital, additional resources, or additional client base? And that truth of looking in the mirror is really important to a founder.
Yeah, good point. I feel like we're mechanical here in the snake dress, so I'm going to get off that. You guys okay? I'm going to pitch you. I'm going to just kick you off, Gavin. So we're.
Appreciate it. It's like you haven't liked anything I've said yet.
Yeah,
That's good.
well, yeah, you're free to go. No, I'm just kidding. No, here, I want to go to this, and I think I'm going to come over here to you, Jennifer. And the question is, our question was, how do entrepreneurs know which funding source is right for them? But I'm going to kind of maybe flip it a little bit. And do you have someone that comes to you and, in the maybe a traditional or maybe non-traditional in the debt world and thinking debt financing loan, and you think, this may not be a situation for debt. There may be an equity opportunity here or something like that. But is there a coaching there, or I guess the question is, how is that? How do they know what's right for them? What's that dialogue look like for you?
Yeah, so the first conversation that we have with a potential borrower is really just a fact-finding, asking a lot of probing questions, trying to understand the situation of the business. Sometimes people make it to us and they're not quite ready for us. And so we have a number of partners that we can send them to, one of which is the ISBDC, the Indiana Small Business Development Corporation. And they have coaches and mentors then that can speak into that process and kind of guide the conversation, debt versus equity. But once someone makes it to us, they've probably been to a bank. They may have even talked to someone for some type of an equity investment, and they've been told no those 8 times. So they're a little beat up, a little bruised by the process. And so for us, we just try to be helpful and offer solutions to, somebody might be in a tight spot, or they've made a decision that wasn't quite the best. They've got a loan from a more predatory source. And so sometimes we're the rescue partner to come in and say, hey, we're kind of a safe haven. Let us help you, let us take care of you, and then we'll get you back to where you need to be. So those conversations, by the time they make it to us, are really more helping out of the situation.
Scott, I'm going to come back over here to you real quick. And, what's it like from an entrepreneur's decision to give away equity? Are you involved in that, or when they get to you, are they fully committed? They're gas pedal all the way down. They're already down that path, or do you sense some I'm not sure where I'm going here. My stomach's churning a little bit. Help me out here.
We see all types, right? So at Vision Tech, people come to us at all stages of where they think they are. That's why, I love the startup ecosystem, so I do spend a lot of time with people that reach out to me personally, and the mentoring I give, I haven't charged anybody yet for it. And, it's just me to help them, and whether they go on to raise money with us or raise money from somewhere else, or a lot of times we point to Elevate. And just for the record, we're co-investors. A lot of our portfolio also has Elevate money in. That's why I said not one VC. So it's, a couple things you need to understand about when you're asking for money from an angel or VC group or person, you only have one thing to offer them, and that's equity in the company. That's your currency that you're offering, because you probably don't have assets in the business. We can't secure anything. It's not a securitized note. If it fizzles and the business doesn't work after a couple of years, we're at 100% loss exposure, right? So we're willing to take that risk. But because of that, you're also going to have control. So one of the things we look for is governance. Do you have other mentors, other people from the industry with some gravitas in the industry that are helping you? Are they already on your board, or you're going to form a board? Like when we lead a seed round, especially if that seed round is a reference to a priced round where we actually price the shares with a valuation that's negotiated. If we're leading, we'll ask for a reserved board seat. Or there'll be some other arrangement where we have some influence. So for example, I sit as CFO of one of our portfolio companies because the founder had a great idea, but was very, very technical and did not have any business acumen. So I sat as CFO to fill that void. And then we also had a member as on the board. And then I also serve on the board of one of our other portfolio companies. So there is governance. And as mentioned earlier, like you have more bosses. There's certain expectations. You need to tell us what you're going to do with those funds. And then when those funds exhaust, because again, we don't look for you to be profitable. We want you to grow the business. Every dime goes back into growth. If you successfully got to those milestones or mostly got to those milestones, it's easier to raise the next round of money. So early on, we look for the team. Is the team coachable? Do they have some prior experience in this space? We love second-time founders and third-time founders, but a lot of them are first-time founders. And if you're first-time founders, who have you been able to go out in your industry or market and convince to be on your team directly or to mentor you outside of that? So those are all things we look at, but you got to have that coachability, like the look in the mirror comment was great. If you don't, it's going to struggle. So I do have a reputation of being very blunt. So when you come to me, I will tell you what the challenges you'll face. But the reason I am is because I don't want you to waste time, because time is the one resource we keep forgetting about. We think about equipment, material, people, and money, but time is important. So if someone tells you the absolute truth of why you're not raising money, that's gold, because now you can fix it and go on and raise the capital or meet the next milestone.
So quick question though, go ahead.
Yeah, I think you bring up a really, really good point. Leading into that, we talk about going to that seed and pricing around. What I've seen is entrepreneurs sometimes, all right. What I've seen is entrepreneurs sometimes can make the mistake, and somebody brought this up about a safe, and sort of the hidden dilution effect of a safe when you shoot for the moon on your seed valuation, and you're like, oh, I got $100 a share. Lo and behold, let's roll forward 24 months, and you own 6.4% of your own company, right? I think that stumble happens so more frequently, and in my opinion, because one, a safe is trickier than everybody realizes. They just think money is money and it's all fungible, but a safe has some trapdoors that are scary. And secondly, to get entrepreneurs to understand, do not moonshot it on your valuation at the seed round. Let's build and make it accretive. So the next one goes from 100 to 185 to sit right. And I think that the entrepreneurs that I've talked to and mentored over the years, they fall into that trap and they're like, I need this first valuation to be, I still got to own, 87%. And you're setting yourself up for your trap. You're setting yourself up when you realize there's a burn here that you're going to need more capital. And I think so many guys forget that.
Yeah, just a quick follow-up on that. So I have met entrepreneurs that are burnt out and call angels and VCs predatory. It has to be a deal that works. So one of the things a lot of entrepreneurs get hung up on is this valuation. What's my business worth at this particular stage? It's worth $6 million versus $5 million, because that goes into the equation of how much equity you have left after we give the capital. So it's just three components: equity, cash, and valuation. Those are the three. And in the valuation, if we say the business is worth 10, it's just we're negotiating. To your point, it's exactly what happens. Yes, we want to push the valuation down a little bit, but it's not just because we want to buy more of your company with the money we're putting in. It's also not to set you up for failure, because what happens is if you as you go in then and start executing and you don't reach your milestones, and your milestones mean you've reached a value inflection point where that point your business is worth multiples of what it was before when we first invested. If you don't reach that, you're setting yourself up that your next round, if you can get money, is going to be either sideways or down, and we call both of those down rounds. And that kicks in anti-dilution protections that we put in the original deal, and that's where you get equitied out. I mean, you lose as an entrepreneur. So we're not just doing it for selfish reasons to get more of your company. We're also trying to say, through experience, here is the stages of similar businesses to yours that you need to shoot for. And yeah, sometimes we lose because we can't come to an agreement, but it's not predatory. We're trying to make sure that you can get to a goal that's reachable.
Do you want to add to this? I mean, this was not on my 3 pages, but we could spend the rest of the session talking about this. I see some deer in the headlights, but.
No, it's great. I'm glad he brought this up, and I completely agree with your comments. Earlier I mentioned hopping on the treadmill, but what I didn't mention is we're joining you. It's like you go to the gym and there's the row of treadmills. We jump on the one next to you because we're having to offer the product of you and your startup to the next investor. We know that our funding ends at Series A, maybe Series B, but we're going to have to sell our portfolio up to the next set of investors as well on your behalf. And so we do want to set it realistically for you, for your own benefit. And it's in all of our interest to price it appropriately so that you can get the next round, assuming, as most startups do, that you do raise subsequent rounds, because that's the way it usually works. Now, I will say the one exception to this is successful founder has money in the bank. It's not never work again, never do anything again money, but significant money, and they have security. They go out and raise at a high valuation because they need capital, they need some, but they plan on that being their only fundraise. Usually that's naivete, but in the experienced founder, it does work sometimes. They raise the one round, they don't dilute themselves very much, and they're able to get to profitability. I've seen that a couple of times. It's very rare. That's not common. Don't go try to do that.
And I think it's exactly that is, for us, we see almost we call it down round prevention almost every single day. We have a company that comes through that got excited early on, some crazy valuation that they got out there. They missed their they missed their markers. Now they're coming in for a true debt, a loan situation to do down round prevention. We literally see it almost every single day. So although it's sexy to run out there and say, hey, I got this new round and this is, how great my company is valued, it is truly a death trap for many of these companies. And I think that it is you looking at yourself in the mirror on, are these projections, do I really believe in my business model? Is it really going to get there? Am I chasing after capital? Because that's going to come back and haunt you later on. And we see it time and time again on the continuing haunt coming back to them.
Just one follow-up on that is, we've had some founders come through and just demand on a certain valuation. I got to get 10 million of the seed round. And why, I don't know, but that's okay. We'll negotiate other terms economically to make us whole again. So we'll get, 1 times 2 multiplier on the conversion, or we'll ask for a 1 or 2 or 3x preference. Like, there's all kinds of economic terms. And if you come to the table and don't understand those terms, and in our experience, I will say only 50% of our startups that pitch to us truly understand the economic terms that are in the cap table, from the agreement. So when you're negotiating, go get mentored so that you also can negotiate with the angels knowing those economic terms. Because if you're really stuck on that number and you want to promote a certain number on your valuation, then you're going to have to give something else up.
I would ask real quick, across the board, debt or equity, is that common where the owner, the founder, the entrepreneur is coming in and they don't understand terms? Is that, I'm in those discussions too, and is that a flag for you guys? I'm in discussions and it's like, I hear the realm of like, you just didn't even take the time to even go Google. You don't even understand the term, and that's like a huge turn off, and you're not doing any homework here. So I'm curious of just this is not what, we're off script here a little bit. So, maybe 30 seconds of, is it happening? Is that where we are right now a little bit?
Yes, and I would say, to add to Jennifer's comment earlier about their process of getting to learn the business, we follow that as well, but part of that is also probing whether they understand their business. And I think that is often very telling. You mentioned like starting a plumbing business, and you may be an excellent plumber, but you may not be able to run a business. And some of this work is like you said, making people look in the mirror and acknowledging places where they could improve or areas where they need to understand better to get to the place where they want to go with their company, regardless of whether it's debt or equity.
And I would also say that there are those who understand their business, but they're so busy working in the business that they don't pull back and work on the business. And we see that all the time. It's a very common trap.
Yeah, the E-Myth revisited, kind of a classic book, if you find yourself there. And then if you're trying to figure out all those terms, a guy here in Indiana wrote a book called The First Time Founders Equity Bible. It's a quick read. You can do it in a weekend. It's a short little text. And I'd have Excel pulled up next to the book, and I'd read it and then try to model it out and see if you can replicate. But it'll show you, what do you have left after you take all these versions of financing that hopefully you're being offered? What do you have in the end if it goes well? What do you have if it doesn't go as well as you thought? So yeah, First Time Founders Equity Bible, really good one. Use that myself.
Yeah, and for us, love the E-Myth book, by the way. If you have not read that, you will find as an early stage founder, you are probably, that story's about you in the book. But for us, well, one thing I think that is unclear for a lot of companies or people in general is that venture, angel, crowdsourcing, loans, MCAs, that is all a form of debt. It's all a form of debt. You are doing a repayment back at some point in time, and it is a form of debt. So there's going to be a gain for somebody else on there. And it's which form of debt at the stage in which you're at right now, which is important, or which capital stack, which could be VC coupled with a loan on top of it. So I think that's important for founders to understand that it is still debt, even if you were to sell equity in your company. They're looking for a return on it. It's just a matter of which form of debt makes most sense for your company for the stage that you're at.
Yeah, we see a lot of an entrepreneur owner come in and want a loan, or they want equity. They'll come to us. Somehow they found us, right? Hopefully through our excellent marketing we do. But somehow they found us, and we'll sit down, we'll start asking these questions, and it turns out that, oh, wait a second, you really do need to raise the equity. Like the idea of a loan is great, and maybe you're at a point in your financials that you can support a loan payment, or we're willing to invest with you too. But a lot of times it should be the equity play, or vice versa. Hey, I wanna come in and raise some capital. Can you help point us in the right direction, or can you guys do that for us? And we'll say, well, let's look at everything. And it comes to find out that Steve mentioned earlier, looking at growth. Well, you've got these 3 contracts already in play. Scott might be willing to help you, but shoot, it makes more sense to just take a loan on those contracts instead of give up some equity at that point in time, because you've already got the business. You might not need the help getting the business at that time and using those other resources.
Let's talk here a little bit. We've got a few minutes here of just across the board. It's important. We all want to hear as we meet the owner, the entrepreneur, of the storytelling of what do we want to hear from them of. It's just not, hey, look at this and look at my financials or my pitch deck or my plan, but they've got to be able to vocalize this and tell their story, where they've been, where they're going, chart the plan. But what's your golden nugget here, or some things that you want to share here of what do I want to hear from the owner here about the business? So jump in. Anybody want to kick off here?
I can kick that off. I think that for us, we want to be sure that you understand the strengths of your business. Certainly, we want to know that, but also the weaknesses, and that you can clearly identify, I know that I need to work on this, and here's my plan for that, or I need help. To me, that is much more important that you realize where you are. And then also, everybody's business may have some weaknesses in it, and just being able to tell your story in a way that helps that loan officer, whoever you're talking to really understand, because every conversation you're having is selling. whether you realize it or not. And so just spend some time, don't just kind of off the cuff, but really spend some time thinking about processing internally your story so that you can be compelling. And it might not be natural to you to be in that selling kind of mode if that's not your gift, but with some work, you can really develop a compelling narrative.
In 2020, I went through my first pandemic. Hopefully, most of you did as well. So we like hearing those stories. If we're working with a client that was around in 2020 or 2018 even, right, or getting started in 19, it's great to hear how they overcame that. So they overcome the objections, the obstacles that you faced, whether you're just getting started or it was the pandemic of 2020 or even further back, go to 2008, 2009 if you happen to do some real estate. But how did you get through that? Who did you lean on? Were you talking with a mentor and that mentor helped you through it? Did you get some extra seed money at that time to keep going? And then as I'm a lender, so as a lender, I can say, okay, hey, great. You've figured out some of these objections you're going to have and the obstacles you're going to have. You've overcome it once, maybe twice, or Jennifer said, you see it coming and I know it's going to happen and I need to get over it now before it truly happens. So being prepared and having those stories about objections and obstacles is key for us.
Yeah, our primary medium is the pitch deck, and you hear that all the time if you're going to go raise capital. There's a ton of templates out there. Elevate has a template they mentioned. They're all basically the same. There's about a dozen pieces of information that we need to see. Now, I don't get so hung up on the order because one of the things we're looking at is you're a startup. There's flaws to your organization at that point, your early stage. But lead off, and this is the way pitching works. We give you a half hour, and we say, hey, 15, 20 minutes to pitch, and then Q&A. But the reality is you got 5 minutes to keep everybody's attention, the first 5, because you are selling. So if you look at all these templates, don't drive yourself nuts about the exact order these templates are in. Lead off with your best asset of the company. Is there no revenue and you barely have a prototype device, but the team is unbelievably experienced and embedded in this industry? Like, start off with the team. If you have early traction in sales and they're starting to take off, but you don't have enough capital to fulfill them, but you can't get a loan, like, start off with the traction. Like, those are 2 components. There's about 10 others. I won't go into all of them, but start off with your best because you want to hold our attention. And we'll ask questions on the follow-up side.
And for us, real quick, and really what you've heard from everybody up here is the plan. What is your plan from a part of the organization should your train fall off the rails? And how deep have you went into really thinking through what is your continuity plan or your contingency plan on that, in true transparency of what's really going to disrupt your company? And I think a little bit of that vulnerability is important to show the other person. Remember, we are your biggest fan. We're giving you more money than your mother. So, we are your cheerleader. You can be transparent with us. We're here to help you solve that. And I think that's what you're really hearing your plan. And I'll share one thing in Intrepid, it's an automatic no. When we ask you your plan, this is a common answer we get, well, I'll just go raise more money. And I'll tell you, that's a show-stopping, do not pass go, do not collect $200. We will end the conversation there because that is not a plan for us.
That's good. Hopefully the first thing I've heard is a question. You've reached out well in advance of your fundraise and you say, hey, tell me more about your thesis, or how do you invest, or what are you looking for? So, we build a relationship early on. Execution is a multiplier of ideas. I want to hear about your unfair advantages and your investable insights, something unique on both sides of that equation. So do you have one of the top team members in the world who does X? Are you in a market that I haven't heard of that's growing at 20 or 30% a year? Do you have a product that's literally, 10 times better than what exists in some key metric? Is your cost of customer acquisition close to zero? Where as long as you get customers, you make lots of money? Tell me what that is and package that up for me in a value proposition statement on slide 1 or before I ever see your slide deck. Kind of to your point, I want to hear who you're solving, what their pain point is, what solution you're providing, why it's better and cheaper and different as compared to the other alternatives that they have. And that whets my appetite, makes me want to ask questions. that's when you say, oh, great, I have a slide deck for that, right? That's what, it starts with the relationship early on, though.
We are getting close to time. Go ahead to the Q&A. Courtney's looking at me. I do want to hit on this, and I want you guys to maybe just, we've picked the kind of the best ofs to come up here on the panel, so we're not going to shout out by name who the others are. But there's this, each of us have these concepts in the you know, kind of these predatory funders and terms, and they're out there both on the debt and the equity side. Just kind of touch on those briefly in your own organizations and your own industries, what those are, as kind of sharing with the owner, the entrepreneur of, hey, just be aware, be knowledgeable of this. How do they crop up? And just kind of share that here for 30 seconds to a minute.
So two that come up for me on the debt side are prepayment penalties, which again, starting early, people usually get into these kinds of agreements when they need money and they haven't started early enough. We refinanced some debt that I think it was $90,000 in prepayment penalties, and it was just, you know, otherwise the terms were okay, but that was pretty egregious. The other one is on term loans. I would always ask, you know, if I can't refinance at the end of this term, what kind of escalation do you typically have? Because sometimes they know they have you, and so they go from 8 to 18, and it's and you have nowhere else to go. And so I think asking that question is always important when you know you're going to have a balloon payment at some point.
If it sounds too good to be true, it probably is. And read the fine print.
I mean, the best thing you can do is make sure that you have agency in a situation, that you have freedom, you have the option of saying no. And so raise before you need it, be well informed, be well educated going in. Predatory practices would be not disclosing things intentionally to you that you would want to know, terms and conditions and requirements and things like that. They would be terms that are an order of magnitude higher than what is standard, and again, likely hidden and obscured somewhere and not presented clearly to you. Yeah, I'll pause there. Lots of other things we can say.
Yeah, tons of ways to be predatory, and right, there's predators in every industry, from plumbing, the coffee shops, the VC and loan side of it. So, and I think that that's really important to understand. And when you look at a term sheet, in our opinion, that is a reflection of your business. You're really looking in the mirror again. If you feel like it's predatory, just like you would get a second quote for your roof or anything else, talk to another provider, including a different provider that provides a different service. If it's a VC, talk to another VC, or a debt solution, or some angel side of it, to bring in another side to really see if that term sheet's predatory. At Intrepid, we're building out a new database or a new algorithm that'll allow an early stage founder to be able to put their term sheet in, loan or equity, and put it in layman's terms what's going to happen, all in real time. You can change if you miss your projections, how your down round dilution works, how priority works. And I think that's really important or key for founders, kind of get the second quote or the second look.
So yeah, when I was on the fundraising side, so I've been on both sides of this fence, and I ran across a company, an investment group, that wanted to fund 100% of our entire round. But then when we got into the details of what that meant in control, it was a non-starter. So don't go into every angel investor and VC group and think that all money is good money. No, some money is not good money for your company. And wholeheartedly agree, you can say no.
I would agree with everybody up here, all good advice. So I just add that, keep in mind that an offer you get on any side, the debt side, the equity side, read the fine print, read the disclosures, and make sure it's what you want. So a lot of times you might be eager to get that loan or get that equity injection, and you're just happy to take it. And all of a sudden you realize, shoot, that's actually not what I originally asked for. That's not the loan terms I thought, just because you wanted that check in your bank account, 24 or 48 hours. So just slow down and maybe get a second opinion from someone. Also say, I really like this deal, but can you just take a look at this for me? Have them read it and give you some hopefully free advice at that point.
Yeah, because your partner side of it could be more difficult to get out of that situation than what you're currently in. And it's almost like a marriage that you're doing when you partner with any of us. And it's easier for you to get out of a marriage sometimes than it is to get out of some of these equity arrangements or loan arrangements that you have. So unfortunately, but it's really understanding, again, what everybody says, that fine print of what happens next, prepayment penalty, how do I get to the next round?
All right, well, we're going to wrap it up on our forward discussion here, but let's open it up to any questions that you guys have of the panel. So fire away. This is the time to...
Quick comment for questions.
Yeah, go ahead.
While everybody's asking questions, since we're talking about books, Ben Pigeon, our executive director, on the B team because he's on vacation in Disney World. The Venture Mindset, I'll give this book away. We talked about mentoring and like embedding yourself in the ecosystem. If the first person through the question and answer that can tell me how much money Vision Tech put into OnStation and OnStation's recent $8.6 million Series A round, you can have the book. But that's one of the reasons why you engage with the industry is to know what's going on and who's writing checks.
Interesting bit of trivia there. I like it. Somebody should just throw out a number. Yeah. But we'll go first question here while we're...
So one of the things that we hear often is everyone has this AI bot that changes and is the secret sauce to what they're doing. You all have your ear to the ground. What's the true emerging market out there that we should be aware of as we're looking for personal investments?
Invest in what you know. Let me start there. Don't invest in things you don't understand or don't know. And so if you are not an expert in AI, find those people around you if that's an area you're interested in, for example. Things I'm excited about, but maybe you should not be excited about, are really niche applications of AI in traditional, boring businesses that just result in a lot of extra money for companies. I really like those, and we can talk about those later. Quantum, I'm very interested in quantum and practical applications of those. We've invested in a company called Quantum Research Sciences out of Purdue that's doing really neat things and actually using quantum in the military right now. So that and aerospace.
Yeah, I would agree. We started hearing AI and machine learning 4 or 5 years ago in the pitches. Then the question is that we always ask is, what problem are you solving for your target customer and why is that valuable to them? And when you get the blank stares, then they're just throwing a buzzword around. So the AI and the machine learning, those things are tools, and they have to deliver a solution to the customer. If they can't do that, if they don't understand what it is, then yeah, I'd stay away.
Just from a lending perspective on the AI, a lot of times some of our competitors, and I know Steve probably runs into this too, Jennifer too, is, hey, we've got AI that can help you generate your loan application quickly and we can get you back information. The good news about the three of us, or all of us up here actually, is I think we may all use a little bit of that still. We're also willing to have a conversation. And AI is awesome. AI is great. It helps us all out in this room. You can use it for lots of things. But find somebody that's willing to have a conversation with you so you can learn about what it is that you're interested in and not just kind of throw that dart at the dartboard.
Hi, thank you all so much for your time today. So the last stat I heard was female-founded companies receive less than about 3% of funding overall year over year. Is there anything anyone is doing specifically to go above and beyond to change that here in Indiana?
Ours is currently around 20% for female founders and owned businesses, I want to clarify. So around 10 times national average. I think part of that's because of our pre-seed funds. We're now in our 4th pre-seed focused fund, and having an open application that's constantly revolving. Anyone can apply. In fact, I won't call them out, but someone pitched this week in this room. It's always open. The door's open for everyone. We want the best ideas. I don't care what someone identifies as or looks like. They should be applying if it's a great idea and they need capital. So yeah, that's one thing we're doing.
I wholeheartedly agree. I mean, we look at things as we're profit motives, even profit motive. We just want the best opportunity. So the team is what matters. So if it's a female founded or underserved minority founded, it doesn't matter to us. If the idea is solid, it works great. One of the ones that we're especially proud of is like Mito Materials here in town. I think they're in your portfolio. They're in our portfolio too. And it's a female led.
I brought that one through.
Yeah. So, no, it's the days of like not being able to access capital in our perspective is gone. Like you just integrate with the ecosystem, reach out to us, we'll coach and help, and everyone has an equal shot.
I want to mention that our pre-seed doesn't require matching funds. So if you've ever tried to raise from Elevate in the past, you'll realize we require matching funds on our later stage dollars. Our pre-seed, we also eliminated that, so no matching funds required.
For us, for companies that are already scaling, so you have some revenue, ours is more of a mathematical equation. So our technology connects to your bank account and it connects to all the accounting systems and it runs through a math. I'm really excited for when we start, everybody is forced to put out their demographics of what their portfolio looks like, because we see it firsthand. But ours, you don't have to sing for supper with us. It's a mathematical equation. It doesn't matter what, even if you're a citizen, what ethnicity you are, what gender you are, and we can see the discrimination just based on what application flow is falling through. We don't know that information because it's just a numeric figure that our system's calculating for us. That's how we really feel like it removes complete bias from the entire equation. It's looking at a company's growth and churn and the success of the organization and the customer acquisition and cost and the efficiency, regardless of who's behind the controls, because we believe that those financial inputs are truly what's driving that business. And that tells us a lot about the business owner, regardless of what they look like or how well they can present or what their gender is.
Stephen and Jennifer, I would love for you guys to talk about your portfolio as well.
Yeah, so we understand that women are historically underserved by banks. And so at Bankable, our portfolio consists of 80% of the loans that we make are to underserved markets, and that includes women, veterans, low income, and minority owned businesses. And so we try to look beyond those demographic stats and to truly look at the business itself and the potential and the bright spots among some of the blemishes that could exist.
Yeah, similarly, we overwhelmingly serve women and minority-owned businesses. And as CDFIs, we're not regulated like banks are. We are regulated through U.S. Treasury, and we have to designate target markets that we serve. For us, it's low-income areas, low-income people, and African Americans. And under the updated regulations around special purpose credit programs, we're allowed to create targeted debt products for those target markets. And the great thing about that flexibility is that banks are starting to realize that, and banks have to go through a whole different process to create an SPCP, whereas we can create them just because we're serving that market. And so banks are looking at ways to partner with us so that they can get preferential service towards those areas where they can't do it on their own. So they're kind of using our programs as a proxy to get to the markets that they want to serve, but fair lending regulations prevent them from doing that.
We've seen an uptick actually in applications from women-owned or minority-owned businesses, which is great. So it's a good start to help the equation for sure, just to see those applications come in.
Cole Guthrie, founder of Prominence. I want to thank everybody for their time today. This has been a lot of great insight. My question is more for the equity side than it is on the debt side. When you're looking at pre-seed or a seed round, you have a founder investor. Landon, you spoke about someone that has a little bit of capital, maybe did okay, but not enough, they can't do anything. They're going to self-fund a little bit. Would you rather see a founder come in, join the cap table, take cash out and have an actualized P&L, with payroll and all the things that come with that? Or would you rather see that founder step away from the cap table, not put any actual cash capital into the company, not pull any cash out via payroll, and have kind of what I'd call longer runway and a less actualized P&L?
In the examples I was talking about that I've seen and participated in alongside co-founders, they put money into the business at a rate that was about 25% compared to other external investors, friends and family. And that seemed to go well because it communicated significant, meaningful skin in the game to other investors. And we would argue real ownership and feeling of motivation in the founder. That would be my preference, is that they would actively put money in. As far as drawing money out, the ones that I have experience with have not drawn money out. They didn't need that capital and that cash flow, but I could imagine a scenario where that would make sense. I just don't have experience with that, couldn't comment.
Yeah, we don't have any hard, fast rules on that, how much money we want the founder to have in, whether they're first time or second time, but we want skin in the game. There is a diminishing return though. Say you're a second time founder and you've had a really good exit and you're sitting on significant capital, and then you go pitch for, a $2 million or $3 million seed round for your next thing, and you're sitting on 50 million. Like, our first question is, why are you coming to us for the money, right? So there is there is some point where it is diminishing return, but no, we want skin in the game of some type. We've entertained founders that barely had 75 to 100 in, but they've worked for free up until that point to get the traction they've got. We take that into account, but someone that's completely not impacted by the failure of the business is a red flag, because we're literally going to give you money, and we're going to lose it if it doesn't work. And then that's why there has to be some skin in the game. But we do each case by case basis.
One of those founders, I forgot, did set a dollar amount at which time they would start drawing a modest salary, like $100K or something. And I think that was $1 million in ARR for this B2B SaaS business. When they hit $1 million ARR, which was all founder-led sales until that point, then that's when that small amount would start kicking in. But again, it's not to the level where they're comfortable and would just ride that as a lifestyle. They're growing the company.
We had a founder come to us. They were looking for $5 million. They were already successful in their other line of business. This was an extension of that, but it was good idea. But they literally told us they were going to draw $400K in salary as a founder. Like, yeah, no, we're out, because we're not funding someone's salary. They've got to have some sacrifice in this too.
And if they're coming in and pitching you on their success, like, you should invest in me, I'm a successful, previously exited founder, and then they're not coming in on the round and putting any in, it's like, okay, well, how much money did you really make? Why are you needing this capital? The story starts breaking down. And so I think it gets complicated if someone chooses to only use other people's money.
Hi, can you guys go a little bit more into, I know Safe Notes had some mixed reviews, so would love to hear more about that versus convertible.
Here we go.
I'll let the expert finish up after me, but SAFE means simple agreement for future equity, and there's no valuation. So let's say you're collecting notes in the 25,000 minimum. I write you a check for 25,000 minimum. I don't have any idea what % of the company I now own, because you haven't got to the point as a founder to put a valuation on it. You're saying, I'm so early, I don't have a valuation. Those are tough in the Midwest. You can probably do it in San Francisco, the Bay Area, but those are tough. We still like to know. So what we look at is notes with a valuation cap, if you're not quite sure or willing to do a full negotiation on a valuation on that note. So we'll see notes with a cap. And then, again, we go to seed round where we do negotiate the actual valuation.
Maybe I'll answer this in a different way too. From an investor standpoint, especially for someone like us. We are a venture development organization using dollars from you all, from taxpayers, right, myself included, looking to create jobs and create wealth here in the state. We primarily, in our pre-seed fund, invest, and as a whole, invest through convertible notes. Those notes, we know, for the most part, vast majority will go to zero, and we'll receive nothing back in order to pay back the state, right, and you all. And so those convertible notes will have interest associated with them, because we know there's some group in the middle that has a very small or modest exit. And that's probably the most likely scenario, right, for anyone in the top 20% of the portfolio, right? And then there are a few companies that do really well. Those are the ones we're hoping the equity plays out and we receive a really high multiple on our capital in that returns the fund and gives us, a positive return. But for a vast majority, as a VDO, investing in a vast majority of the companies, we're receiving a little bit of money back from that small market or lower than market rate interest on a majority of companies. And so they might have a small exit, which is great. We want that in the state. We want them to go on and start their next thing that might be really successful sometime. But anyway, we have that interest on our convertible notes in part because of that reason. So we can return some money back to the fund and invest in the next entrepreneur and the next entrepreneur until we have the large exit. We also, like with any of our answers, be aware. Make sure you have agency when making decisions. You are making conscious choices and you understand term sheets. As he was saying, we really don't know what the valuation is on some notes, especially uncapped notes we see on people moving into Indiana who come from the coast. And even for a cap note, you're really not sure what's going to happen. You don't know what your next fundraising will look like. And when you have a safe note, and then you raise an additional safe note, and then in your next round, an additional safe note, and you have these stacked safes, it creates a waterfall effect that's very unpredictable. And your future valuation in a price round all of a sudden creates this waterfall that you really had a very difficult time projecting prior to that valuation.
We've run into that where people brought us a series of notes, safes and caps, and then we model it out ourselves because we want to know where we stand, at that point, stage of company when we invest a certain amount. And we've had to walk away for deals because we feel like there's not enough left even for the founder to be incentivized to keep going.
Yeah.
And so we've actually had to walk away just simply because of those issues. So that's why mentor early. Go talk to people early to understand what the impacts are.
We have a model. We'll flip our computer around and show entrepreneurs, and we'll say, look, you have very little left. I can't, in good conscience, invest in this knowing that you won't be motivated here in a couple of years. The other reason why we do convertible notes is it is a debt instrument. We're talking debt equity, but actually we're investing through these debt instruments that convert into equity. And so those debt instruments sit above safes whenever a liquidity event happens. Okay, so whenever let's say someone has most of our exits, very small. And so someone has that exit, a safe, they never get any money back. It goes to zero, safe holder, while the convertible note does pay a little bit of money and a little bit of interest back, again, to our fund, so we can invest in the next pre-seed first-time founder.
With the growing trend of entrepreneurship through acquisition, are there any groups in Indiana that are really investing in that outside of your traditional bank lenders?
Actually, I've been pursuing that separately from a personal level. There are search funders. It's all about networking and finding those investors. So I recently secured two partners. They don't call themselves private equity, but they have 4 businesses now looking to acquire another one. So I can go down that path. But that source of capital comes from everywhere, whether they're named as a PE company or a search fund. It's all about networking and finding people that are interested. But that is an excellent avenue to get started in business, so you don't start from scratch.
Daryl Starr with Little Engine Ventures is such a thoughtful person. I would recommend. He lives up in Lafayette. Yeah, Little Engine. Yeah. So he's an entrepreneur. He and Michael and several people involved, sounds like you're familiar. They are entrepreneurs in their own right who did raise other people's money and put their own money in. And they do, acquire and run and hold companies for cash flow.
All right, I think we need to wrap up. So I'm going to put a number on the board. I'm going to say,
Any guesses?
I'm going to say 3.5 million.
So
That's my number.
That's, yep. 8.65 was the full round.
Yep.
How much money did Vision Tech? That's a little high.
Okay.
Yes, sir. Excellent.
Yeah.
Well, I gave you time to use the Google machine, so that's.
Oh. Way to go. Well, hey, I appreciate everybody coming out. I hope you found this a valuable use of time. We could do this the rest of the day, but I encourage you to stay connected, connect with the panelists here. I've known a couple of these guys. It's been great to meet Jennifer and have her up here. I'll stay connected with them. Maybe we'll do this again. We could go down this path and talk safe notes and keep on that and other things. But thanks for coming out. We've got a chance to kind of hang out here a little bit. So feel free to extend a hand, say hello if you don't know one of them up here, exchange contact information. But again, appreciate your time and thanks for coming to Launch Fishers. Have a great afternoon, everyone.